Hi, my name is Ujat and welcome to Rock with Option, the show for all your option needs. Today we're going to talk about a very critical parameter that helps us predict market movements. It's called PCR, put call ratio. If you watch CNBC TV 18, Anuj Singhal or Nigel D'Souza always rely on PCR or the put call ratio to talk about near-term market texture. Given the volatile conditions, we decided to take a deep dive on this particular parameter. Today, we're going to talk about how we can use PCR to predict market movements. We're also going to talk about where to find PCR and the shifts in PCR that can help us in getting in and getting out of option buy trades. So what is a PCR? As the name suggests, it is the ratio of puts to the calls. It is one of the most critical parameters that any FNO trader should take note of. This helps us in evaluating short-term market texture and movement. There are two types of PCR, PCR OI and PCR volume. PCR OI measures the ratio of put option open interest on a given day to the call option open interest on the same day. PCR can also be represented in terms of the volumes on a day. So PCR volume is the ratio of put trading volume to the call trading volume on any given day. While PCR OI represents the stock, PCR volumes represents the flow or shift in the marketplace. While both are used, the PCR OI is normally the stronger indicator of the trends in the market. PCR can be found for both for indices as well as stocks. For PCR to be accurate, liquidity of the options is highly critical. It is for this reason that usually PCR is evaluated at an index level. An example, if the put call ratio is 1, it only indicates that there is equal number of put option and call option in the system. So where do you find the PCR information? My go-to source is the NSE India website. They update the table that you see on a daily basis at around 6:30 p.m. and I find this the most accurate source for PCR ratio. However, you can also take advantage of websites such as Sensible or Opstra, which gives you a more pictorial or graphical representation of PCR, which can help in assessing the trends of PCR in the marketplace better. If you're following me on Twitter, I also talk about and put out enough notes on PCR and my assessment of PCR and the short-term market texture. So now let's talk about what PCR means and what is the significance of PCR. If the PCR ratio is between 1.6 and 0.8, it is considered, the market is considered to be in the neutral zone. It's a no entry zone, so it means that one should avoid taking any positions in the marketplace solely or exclusively based on PCR information. If the PCR drops below 0.8, we are entering into the oversold area. In this case, there are significantly more call options than put options in the system. One needs to watch out for a short-term bullish trend reversal from these levels. So one should add both the PCR as well as the index on their watch list to identify the point of a bullish trend reversal. If the PCR moves above 1.6, we are moving into the overbought territory. There are significantly more put options than call options in the system. Again, from these levels, one can expect a bearish trend reversal. Again, one should carefully observe the trend in PCR as well as in the index to identify the start of that bearish trend reversal. Now let's get into the details of the mechanics. Now let's talk about the mechanisms one can implement to take advantage of our learnings about PCR from the previous slide. Let's talk about an instance where PCR has dropped below 0.8. That means the index has moved into that oversold region. As discussed earlier, one can expect bullish trend reversals from these levels. When that bounce happens, PCR again moves back into the neutral zone between 0.8 and 1.6, establishing an equilibrium in the marketplace. During this trend reversal, buying call options really yield good results. Which call options to buy? Buying at the money or closest to at the money call options is preferred. You need to also make sure that the options that you're buying is highly liquid. This ensures that the option pricing is accurate. You also want to give enough time for the trend reversal to play out. So buying monthly option contract or weekly option contracts, which is about 7 to 10 days away from expiry, is recommended. Now let's take a specific example and see the outcome. Around the last week of February, PCR dropped below 0.8 and the index moved into that oversold region. We saw a bounce back in PCR from its lows of 0.63 and was moving towards that 0.7 levels. Nifty spot at that point was 16,300. So the options that we considered for buying was the March month, since we were at very close to end of Feb. We considered buying March month call options, 16,400 call options. And we also considered buying March 3rd, weekly March 3rd call options at 16,300 and 16,400 levels. This ensured that we had enough time for PCR and the index to bounce back from this levels. However, in this case, Nifty within a matter of couple of days bounced back from the lows of 16,300 to about 16,750 within a matter of 2 days, giving us a really positive outcome. Now the reverse is also true. So when PCR moves above 1.6 and move into the overbought zone, there buying put options yield some really good results. Again, the mechanisms is the same. You buy at the money or close to at the money put options and give yourself enough time for the trend reversals to happen and see some really positive results on that put option. Let us continue with the example that we discussed in the previous slide to talk about the hold and the exit mechanisms. If you remember, we bought call options when PCR dropped below 0.8, that is Nifty moved into that oversold region. We continue to hold on to that call options as long as the bullish trend is intact. That is, the PCR as well as Nifty is steadily rising during the day. Usually PCR stops dropping when Nifty hits that resistance level, which is a bearish indication. And it is at this point that we close our call options and take home our profits. So reiterating our exit criteria, as long as PCR and index is in sync, either rising steadily in case of a bullish trend reversal or dropping in sync in case of a bearish trend reversal, we hold the trade. When we start seeing PCR to reverse, which happens very close to the support or resistance regions, it's time to exit the trade and book our profits. In summary, so with an example, we are able to establish that PCR is a very critical parameter that can help us gauge the market sentiment and the market texture in the short term. If you're an option buyer, adding PCR to your trading mechanisms would significantly enhance your trading outcome. If you've liked what you have watched, do subscribe to us. Till we see next time, trade small, trade often. More importantly, happy trading.